But let me take off from what you said and sort of take it back to Prachi. You talked about the sharp decline in consumption. Two issues were raised. One, of course, was whether or not there's a massive wealth effect playing its way out in consumption. And the second issue was now the access to credit for consumers. The two have very different implications in terms of how the financial sector actually thinks about it and deals with it. Do you think these are fundamental factors, or do you think they're not that important and it's something else altogether?
Thank you, Dr. Sen. I think great question. I think let me rephrase your question. I think the two effects which you point out, I think to me they are, the first is a credit demand effect and the second one is a credit supply effect. If you ask me at this point, I think which is a big question, what is binding? Is credit demand binding or credit supply binding? I think my own research as well as my sense, looking at the data very closely, at this point, to me it seems that credit demand effects are more binding. Credit supply effects, which relate to the topic of the discussion today, shadow banks, non-bank financial companies, I think they are important. Some of the fundamental issues which Ananth raised are all there, but my sense is that they are less than they were a couple of months ago. But of course, I think this is a big question. What is binding at this point of time? And it seems to me that it's more the credit demand issue, which is related to some of the fundamental factors. Look, this is an economy which has gone through two big structural shocks over the last few years. GST and demonetization. I think everyone knows that smaller firms are finding it harder to survive in this environment and are deterred. It's not that cash has been wiped away, but they're deterred from using cash at the margin. And smaller companies, I don't have data to back this, but smaller companies have closed down, which has led to exactly what you said, the first effect, lower wage growth, lower income growth, and leading to lower demand for goods and services, and in turn leading to lower credit demand, which my view is at this point is the binding constraint. Credit supply issues were very important a year ago, but perhaps less so now.
Thanks, Prachi. Ananth, let me come to you. You made an interesting observation, which was that wait till the mudra defaults start hitting the banks, right? Let me provoke you a little bit on this. My sense is post-demonetization, what kept this economy going was, in fact, mudra loans. So for 2 years, it's the mudra loans which kept us afloat. Now, if they go bad, is it a price worth paying?
I agree with you, Dr. Sen. I think mudra is what probably kept the engine going, particularly after the shocks that Prachi just mentioned. Some of my students happen to be ex-bankers, and some of them were credit officers who were disbursing loans at the micro level. And some of the stories are quite interesting. When mudra was first launched, there was a quasi-deadline given saying you have to meet so-and-so. There was no actual hard line drawn in the sand, but there was nevertheless an indication that you are supposed to maintain a certain level of credit growth there. And at least for the first few months, there was a scramble out to catch hold of the Andes walking on the road saying, can you please take a loan from me? Here's some money from me. Particularly for the, I think it's called the Yuva, the 50,000 rupee category of loans. Issue. Bankers are a funny lot. In public forum, they will say everything which is right. Oh, it's all coming back, don't worry about it, it's all coming back. You've got to catch them in the water cooler or in the evening when you're having a quiet drink with them. The candid feedback is none of that 50,000 rupees is coming back, or a big chunk of that is just not coming back. It's essentially gone out into the ecosystem, right? I think that's bad news. I don't for a minute dispute the fact that it helped the economy at a time when we needed help. But a big chunk of money not coming back at any point of time and adding to the NPAs is, I think, is a problem. Can I segue this into the earlier question you asked, Prachi, as well? This thing about consumption and what is it that is required to spur consumption and financing in India, I think a lot of it goes back to growth. If we can see economic growth and see employment coming through, I think consumption will follow. Now, there is a big debate doing the global rounds that because populations are aging, because your inflation seems structurally conquered, Therefore, the good old days of growth are gone, and no longer will you be able to aspire for that kind of growth. I'm not sure that logic works in India as yet. Our per capita income is still $2,000. We have a long, long way to go. We still have a very, very young aspirational population. If we can get back a sense of growth, I don't see a problem with consumption at all. I think it will come through, which is why I think the starting point has to be, just as we had in July 1991, which was a huge fillip to the prospects for growth on an ongoing basis. If we can come up with some really strong structural reforms which at least bring in the confidence of growth coming through, I think consumption will follow. And I agree completely with Andy. There is a wealth effect, there is a job effect, there is a slowdown effect, which is all of it coming together to depress consumption. If we see that hope of growth coming back again, I don't see a problem at all in consumption.
Again, you made a statement which said that this collateral chain problem is going to come and bite you through the NBFC route. And so 40% exposure is to the NBFCs of the banking sector. This is true. But let me make the following proposition, that given the relative strengths of banks, who are great deposit-taking institutions but lousy lenders in terms of the ability to, which is the point that Ananth was making. Whereas the NBFCs don't take deposits or not supposed to take deposits, their real strength is actually in terms of what they do on the loans. It's almost like a marriage made in heaven, right?
Exactly.
What went wrong? Or has anything gone wrong?
No, in fact, the marriage will now be solemnized.
Now be solemnized.
Yes. I think, let me sound the first cheerful note of the evening. I'm not talking about the big reforms that will happen later. But one of the things that can happen pretty quickly, and the market will drive it, is the start of a co-origination model of lending. So co-origination meaning that 80% of the value of the loan will come from the bank, 20% will come from the non-bank finance company. The non-bank finance company will source the customer, will do the documentation, will prepare the credit memo, and then the bank and the NBFC, their information systems will be talking to one another, and they will be in agreement over risk policies, and a loan will finally be given jointly by the two of them in the manner I just said, 80-20. And then the NBFC might also want to give a first loss guarantee and sweeten the deal still further for the deposit-taking institution, which simply doesn't have the wherewithal to either source a good customer or to actually take a call on whether this customer is creditworthy. Because the public sector banks in India in particular are good at lending against things, or they think that they are good at lending against things. But lending for a business, for a purpose, is not something which is really taking a view on a borrower's cash flows, is not something that they can do. But this is something that they can do jointly with the NBFCs.
You've been a banker, right? And you were...
Guilty.
No, guilty, right? But you were a banker at a time when, if my memory is right, nearly 80% of Indian bank loans were essentially for working capital. And the remaining 20% was retail loans, essentially to household for home purchases. Today, the last figures I saw, 48% of bank loans are for fixed capital, bank loans. And working capital has dropped to 36%. So question number one, are Indian banks geared up for fixed capital lending? Do they have any sense of what they're lending against? Number two, if Indian banks have vacated the working capital lending space, who on earth has taken it over?
Great question, Dr. Sen. On the first part, and I know where you're coming from, banks have short-term liabilities. They should be doing short-term lending, liability mismatches, tenor mismatches. Likewise, you should have pension funds, insurance companies, longer-term savings gathering institutions which should be lending out for infrastructure, or foreign capital should be financing infrastructure. That's great in theory, but if I look back at all the countries that have grown and moved from developing to semi-developed or developed status, the initial set of infrastructure lending has always been done by banks. The domestic savings being channeled typically comes through banks. Yes, we have FDI which comes in, which fills in a big chunk of the international space. But at least domestic channeling has come through banks. It's a conundrum. At some stage, I think our pension funds, insurance companies, etc., should be allowed a lot more freedom to invest in more into infrastructure and better assets rather than banks. And maybe that shift should happen. In fact, I was at a conference where the Canadian pension fund was there. And she was making the point that she invests a lot of money in Indian infrastructure, whereas her counterparts in India don't touch infrastructure at all.
After all, the government of India actually preempts 50% of this money, so they don't have that much to lend.
On the working capital bit, I completely agree with you. In fact, I'll add to the trouble that you mentioned. We know that the government has been delaying some of the payments. Hopefully that will get resolved now. The finance minister has taken cognizance of that. But in a funny way, because GST has to be paid on an accrual basis, you pay the GST even before you receive the money and the money never comes in. And therefore, working capital cycles have actually stretched even further. At a time when the working capital requirement has gone up, and frankly, investment demand is simply not there. The people are not asking for money for investments. It is kind of sad that banks have gone back on credit because they're scared about lending in general. And unfortunately, working capital has taken a deep knock. I go back to the reform of banking, unfortunately. I think eventually this requires reform of banking. I really like the recommendations of the PJ Nayak committee, which tried to bring in a distance between Delhi and the banks. Something like the Temasek model of Singapore, where you have DBS owned by Temasek, owned by government of Singapore, and therefore, at least at an operational level, a lot more of autonomy and freedom. I think something like that would probably open up banking to be less scared about general operational decisions, and therefore free them to taking better decisions going forward. There is an entanglement happening out here which has to be unraveled at some stage.
Prachi, just going on the same issue. At the end of the day, we do know that current production is in fact working capital driven, not so much the fixed capital part of it. Now, if what Ananth is saying is correct, which is that there is an increasing reluctance of banks to do working capital loans in a situation where the working capital demands are being stretched, does your story change? Because your story was a consumption-led slowdown. But this could be essentially a production-led slowdown driven by insufficient availability of working capital.
As I said, if you look at India's heydays of economic growth, 8 to 9%, no matter what base or base years you use, and now, the decline is almost entirely explained by the sharp collapse in investment, because the contribution of consumption is more or less unchanged. Exports have slowed down, but imports have also slowed down. So net exports is not really a drag. It was always a drag and remains so.
Can I question that?
Yeah.
Because a large chunk of the import decline is basically oil price. The volume of oil hasn't changed that much.
Right.
Whereas for your argument, it's the volumes which should matter and not the values.
I'm looking at real growths and all of these, and then we can question how the deflators are, etc. But I'm basically using the data we have and not questioning that at this point. So it's entirely driven by the decline in investment. So to me, it's, till now, it was an investment decline. And now if consumption also slows down, we really need to think about, what are the prospects of growth going forward. And this debate is, I think, important in the context of US-China trade war, escalating, and whether India can actually come and occupy some of the space. And if that happens, I think potentially that could happen. I think in reality, as Ananth had pointed out, there are lots of issues. I think if that happens, I think demand for working capital loans, once investment picks up, demand for working capital loans should pick up. And then I think if the demand is there, to me at this point, that's the binding constraint rather than credit supply by banks or by non-banks.